Welcome to another episode of Breakaway from the Rat Race. And today we have the pleasure of speaking with Hale. Terry is an active investor and CEO of a private commercial real estate firm. His firm uses extensive commercial real estate expertise to create value by repositioning and stabilizing assets for long-term capital gains. Terry is also an author, a public speaker, and regarded as an authority in commercial real estate investing. And Terry actually has been featured on CBS Radio, CNBC, and several syndicated radio broadcast networks. And now today is on Breakaway from the Rat Race. So Terry, welcome to the show.
Thanks, Eric. Thanks for having me, man.
Yeah, so tell us more about your firm, your company, and what do you do exactly? I mean, I give a little bit about the introduction, but it's kind of like, a little bit vague. So what do you do exactly?
Right. So, Eric, my company, we've been in business for over 25 years. Myself, a little over 25. And what we focus on is these reposition type of properties. So properties that are suffering, properties that have vacancy, a lack of income approach, possible light rehab. And these properties are plentiful in all market conditions. And we really hit the nail on the head, identifying that there's either going to be problematic situations with the property itself, or there's a situation with the actual individual that owns it. So there's two sides, right? There's two sides to that. And so I opened up this firm years back to really identify opportunity. And there's a lot of speakers and coaches and mentors and these types of folks out there that they talk a good game, and maybe they have this one kind of shtick that is really appealing to people. But not a lot of these people, I'm sure, as you know, Eric, are out there actually doing the business.
Yeah, that's right. Yeah.
Space, So there's two parts to it. Maybe they're a one-trick pony. They've done a couple deals, but right here, our primary focus is acquisitions.
Yeah. That's what I noticed as well. A lot of people that you follow on YouTube and stuff like that, they're very popular. They have a big following, but they don't actually do investment.
Right.
They're educators. I mean, some of the information they provide is good, but they're educators. They're not real estate investors. And so this is kind of like the difference. And you are a real estate investor. You have your own real estate firm, obviously, that does that. So tell me a little bit more about, or tell us a little bit more about kind of like, what do you mean about kind of repositioning? Because that's kind of the nice thing about commercial real estate compared to a single family home. A single family home, it's kind of a home. You can add some bedrooms, you can do some renovation, maybe add a second floor, turn it into a duplex maybe. But you're kind of limited in what you can do because of the zoning. On the commercial side, I think it's you have a lot more options. So can you give us some example of what you mean by repositioning?
Yeah, so you're right. There is definitely much more opportunity for commercial, both in actually improving the property from its current condition or its current state. When I say repositioning, it's primary the actual occupancy level. We're focusing on properties because there's two different types of properties, right? So just to be transparent, you have asset class and you have liability class. And an asset class, as we know, is something that is an asset. The reason why it's an asset is because it's operating at its highest and best use. That's a property we typically never focus on, as something that's already 100% full. It's already renovated. It doesn't have any CapEx, which stands for capital expenditures in the future. It's done to the nines and it's being sold at top dollar. Like those deals are all over LoopNet and City Feet and Crexy and Argus and all the different websites for different property types, mobilehomeparkstore.com, all that stuff, right? We're focused on a whole different positioning of property, and hence the name repositioning, is because we're taking it from its liability state, not the asset, but the liability state, where it's really operating at very low occupancy levels. The rents haven't been raised in a long time. And again, problematic situation with these owners. We found that obviously we're in a baby boomer scenario where a lot of people are not just retiring, but unfortunately as part of life, they expire. And so when people leave, they inherit property. We've been seeing more and more of these inheritance properties. When somebody gets a windfall of capital, like they win the lottery, we all have heard this. People get windfalls of money, and what they do, they go and spend it, right? That's what they want to do.
Yeah.
Somebody inherits a property, they don't want to say, oh, let me wrap my head around how I'm going to manage this thing and deal with tenants. Most people are like, introvert on extrovert, so they just want to take it, sell it, take the money, and disperse it to something where they're comfortable doing, which is spending it or investing it in, like you said, a house, right? So when you have a property that is repositioned, we get in there, we actually automate the process, we modernize the process, we bring in third-party marketing management collections, and we run it as a business, which is refreshing because most people, the mom and pops that are out there running these, we find that a lot of times they're just out of gas.
Yeah.
They're just tired.
Yeah.
They're tired, especially with the self-storage too, Eric, because if you just imagine, these people purchasing it on a tract of dirt, maybe even doing some additional development, having an actual developer go, do the grubbing and grading, lay the infrastructure, go vertical with these big boxes. They're sitting on a couple hundred, maybe 200-300 unit self-storage. They're waking up every day, going in, sitting in front of that box, watching Judge Judy or whatever. And they're just tired. They just want out of that, you know what I mean? They're just done. And a lot of times what's crazy is these people, kind of the secret sauce is these people have owned these properties for so long that they've actually been paying principal and interest, and the principal has reduced the amount of debt. And then the property's not operating at its highest and best use. Maybe it's sitting at 70% economic occupancy. It's still covering the debt because the debt is so low because they owned it for so long. And all that additional 30% upside, when we reposition these, we can realize and capture all of that like built-in equity. Because then at that point, all we have to do is bring in the professionals that we hire, let them do what they do best. We focus on what we do best, which is locating these properties, pre-screening them, evaluating them, structuring them, negotiating them, closing them, and then doing it in the way where we actually build a business. And every time we close one of these storage facilities or a multifamily or a mobile home park or big box warehouse, we're actually keeping it in its own independent operation, in its own business model. So anybody that's interested in this, you can easily learn it and then go apply it. And I'm not here to insult anybody's intelligence and say that it's a push button process, because it's not. It definitely takes some work and it takes the learning curve to understand it, but you can duplicate the process and anyone can.
I mean, this the multifamily, we had some apartment buildings in Memphis. We sold them now, but when we bought them, I mean, we bought them from a gentleman that was older, and he was self-managing the property. It was like a 20-unit apartment building, and or was it 16-unit apartment building, and then he was just kind of tired. He knew all the tenants and all of that kind of stuff because it was the whole thing. And he was doing like basic repairs, like only what was necessary. And I can imagine that if you inherit something like that, right? And then you just look at it and you say, oh God, how much money do I have to put to fix it up? Like $300,000, $400,000 to fix it up. I don't have that money. Like what kind of inheritance is this? I want to sell it. I want to get rid of it, right? So there's a lot of that going on. So anyway, this guy didn't pass away, but he didn't see, he was tired of it, and he wanted to get rid of the problems, having to deal with that. So he wanted to get his money out and then move to a triple net investment. And then, but the thing that was interesting is that he didn't see the value in the building. He didn't see any kind of value in adding and doing more renovation, bringing better curb appeal, and he certainly didn't see that it was possible to increase the rent. He said, you can't raise the rent. That's the first thing he told us when we walked the property. He said, you can't raise the rent here. It's just like, this is just like, this is a maxed out. There's like, blah, blah, blah. Well, good selling job. And we ended up doubling the rent, but pretty close to that, like maybe, 100% or close to 100% increase. So that was phenomenal. But that's the advantage. There are properties out there, and but to my knowledge, they're hard to find. So what are some of the tricks that you might share with us on finding these properties? I mean, they're hard to find on LoopNet. LoopNet, as you mentioned, they're pretty much done up for the most part. But where do you find these other properties because for me, I mean, I'm having a hard time finding them.
Sure, sure. Yeah, well, we find them, they're both on market and off market. There's plenty of properties that are on market, and there's key identifiers that you can look for to help out with the journey of locating. One of the things we look for always would be price reduction and also days on market. Your average broker has a listing that is 180 days, 6 months, right? And that 6 month listing, they put time, energy, money into marketing, getting the message out to the people, and they field hundreds of calls, especially if they have it on LoopNet. They're getting pinged both by direct messaging and also, by calling their offices. Yeah. So they're fielding all these calls. And what we find is that when it gets close to like that 180-day marker and you see that it's been on for over 100 days, they're pretty much over it. They're ready to make a deal. Yeah. And, probably several different offers have come in, lowball offers, people that are fresh out of boot camps that are told to just make these lowball offers, and they're out there. And, these brokers, they have a fiduciary duty to present offers. Yeah. So they present an offer, and then the seller looks at it and says, well, this is way less than what I originally discussed, and you gave me your broker's opinion of value. Yeah. And this is less than what you gave me. Then the brokers now, they got egg on their face, and they're starting to lose credibility to the seller. Yeah. So there's that motivation factor that starts occurring, and that's a good key identifier for online. Finding deals offline, you can purchase a list and smile and dial, no doubt. There's other platforms like Reonomy where you can get direct cell phone numbers to owners of commercial property. You can do direct mail campaigns as well, just like they do in the house buying business. But the main goal here of finding these off-market deals is also just connecting with brokers and speaking for purpose and clarity, and having it in a position where you know exactly what you're saying and how you can attract these brokered bird dogs that can get out there and present opportunity that perhaps wasn't present. Well, the average person that gives a call on multifamily or storage or whatever property type it happens to be, the average person that calls on that, if they stumble on the call, they're losing the whole approach of being that authority figure, right? And especially if you get in there and just make a call and they feel like you're the competition because you're perhaps flapping your lips saying that you own other property. Mm-hmm. They could feel like, oh, this is my competitor calling me trying to get my property. Yeah. And that could be a real instant no, where you have these brokers and the brokers out there making the connection, and they hold a license. I mean, that's what they do, is they list and sell property. So they definitely have a better lead in, I feel, and you can get a couple brokers on your side to find and the right properties in the right markets with the right situations. Mm-hmm. And then that's pretty much where the hidden deals are in commercial real estate.
Yeah. Okay. That sounds good. Any kind of like type of properties in particular that you're interested in commercial? And you mentioned self-storage, but on the multifamily side, any kind of like size that you're looking for in the number of units, any kind of markets that are better than others?
Yeah, so there's definitely a location and a net rentable square foot design. You're not going to want to go and look at something that's 6,000 square feet. That makes no sense, right? That's just like a big house. What you are going to want to look at is something typically that's over 20,000 net rentable square feet. It's got some meat on the bone. And a lot of these investors that want to buy these deals, their number one question is do you have anything that's over 20,000 net rentable square feet? As far as like locations, any location that's trending, that's in a submarket outside of MSA, which is a metropolitan statistic area, is good, but you don't want to be out in the sticks or any areas where you're looking at. Anybody can look in an area and, like, if you're not familiar, like I'll just mention wherever, Tyler, Texas, let's say, and you just go Tyler, Texas population. You can even just do POP. It'll pull up a little grid, and Google's smart enough to show you, basically, are there more U-Hauls coming in the area or more U-Hauls going out? Yeah. So anytime you see a declining population, it's going to be a tough deal to resell. whether you wholesaling the paper, or you close it, reposition it, and sell it later. People want to buy deals, and that's it. They want a deal.
Yeah.
People are not out there, no matter what transition, because we buy and sell here all the time.
Yeah.
And just for clarity for all the listeners, I do not have a actual license in this business. I have 2 licenses. I got a marriage license and I got a driver's license, and that's it. All right. Yeah. But there's that learning curve. And for folks that are going to stay on until the end of the call, what I want to do is I want to offer them some additional knowledge base outside of this short overview. I authored this book, which is the 2 best strategies to profit with commercial real estate. And anyone who stays on to the end of the call, not sell it. I'm going to give it to you for free. And I'm going to make sure that it's a deliverable, a digital deliverable. So all you have to do is email me, and I'll give you that email at the end of the call here. But I want to make sure I can put this in everybody's hands to do a service. And it is a service because it's sharing additional strategies. Yeah. So there are 2 strategies that I use, Eric. We put the deal under contract once we understand that it's a deal, right? Yeah. And what makes it a deal is the fact that it has enough upside, right? I always say, is the juice worth the squeeze, right? Yeah. And some of these deals are just maxed out and there's not a lot of money in them. Yeah. I'm typically not going to touch a project unless I can make a minimum of $100,000 on it. Yeah. And the way I make that money is I take the property, put it under contract, show the value in it, and then what we'll do is we'll go ahead and wholesale it, basically. Okay. And we don't use the term wholesaling because that's kind of like a dirty word. Yeah. What we'll talk about when we do that.
I don't think it's a dirty word, but yeah. Okay.
Some people do. Brokers hate it because brokers are like, oh, this guy doesn't have any money. He's just wholesaling. Yeah, yeah. And it's far from the truth. I got very deep pockets, but I also have very short arms. So I practice what I preach.
Like that. I like that.
Yeah. I practice what I preach in this business,
I mean, it's a great return. I mean, if you can do that, if you're a deal finder, and you find a good deal and you don't want to go and keep it for like, put $500,000, work with JV or your own money and stuff like that. And I mean, this is a much better return. You put your earnest money deposit, you find a deal on the other side and,
just sell it. Yeah, I got 3 projects on the market right now. I actually started something called the Commercial Buyers Club. Yeah. And we have thousands of people on that platform. Yeah. Just because people kept reaching out to my office and saying, hey, what do you have? What do you have? What do you have? Yeah. And obviously with the power of social media, you put a project out into the marketplace once you have it under contract. And it's like people, they come out of the woodwork. Everybody wants to be an investor. But again, everybody wants a deal.
Yeah, exactly.
And what one of the metrics that we use is a standard formula that a lot of these lenders and investors and even brokers use to evaluate property, which is the cap rate formula. Yeah. And the cap rate formula is actually a lot easier than one would think to understand. And I'll just brief everyone on it real quick. It's your gross income. That's everything that the property makes, right? All the money that the property produces for all those tenants, regardless of the property type. Once you have that gross income, then what you do is you take your itemized expenses, and they have to be justifiable expenses. Your Mercedes-Benz lease payment is not an expense, right? But when you have your taxes and your insurance and your utility bills and your management expense, and then you factor in for CapEx, which I mentioned earlier, capital expenditure for future issues that may arise from the property, like new roofs or new HVACs, heating, ventilation, air conditioning units. And then you put in a little vacancy factor. You actually have this itemized expenses, and that could total at like 25% of all your income, or 30%, or even in some cases up to 50% of your income are through itemized expenses. And once that happens, then what you're going to do is you're going to take the gross income, you're going to minus out the itemized expenses. That's going to leave your net income. A lot of people have heard of net operating income, NOI. The formula is actually real simple. It's the NOI divided by the purchase price, which equals the cap rate. So if you took the NOI and then you divided it by whatever they're asking for the property, you're going to come up with either a double digit or a single digit number. Mm-hmm. And the double digit's better for the buyer, and the single digit's better for when we sell. Yeah. Because if you're buying it like out here in Malibu, California, where I'm located, they're trading property, I kid you not, at 1, 2, and 3 cap.
No way.
Yeah, there's a property in Malibu right down the street from my office on Canaan and PCH that's on the market right now on LoopNet, and I believe it's like a 1.7 cap.
Wow.
It's like how can you buy?
I think they're at, even San Francisco, they're at 3 or 4 or something like that right now.
Sure.
Yeah.
So here's
it's in Malibu.
Right. So what we do is we focus on buying at 9 and 10 caps.
Yeah.
And if we find an 8 cap, the fastest way to turn it into a 10 cap is just lower the ask price.
Mm-hmm.
And that just comes down to how you orchestrate that negotiation and justify what you're doing.
Yeah.
And why are we able to buy those so people don't have their BS detector going off, right? Yeah. The siren going off. We're able to buy those.
You heard it? You heard my
I thought I did. Well, I hear a truck backing up in front of the office, so.
But that's true. I mean, I'm kind of kidding, but it's hard to find right now. I mean, the 8 cap rate. I mean, that's what when I bought my apartment buildings. I mean, they were in the 8 cap rate, but that was like 3 years ago.
Yeah.
And they needed a lot of work, so that's kind of interesting. So you can still find deals right now above 8% cap rate
every day.
Wow. Well, I'm doing something wrong.
You got to get the buck. I mean, the fact is, going out and looking on LoopNet at 8 cap, you're going to have a very tough time trying to find something that's on the open market because the brokers want to sell at very attractive caps because they only eat what they kill. So they got to sell at low caps because it affects their commission, right?
Yeah.
So it's really basic. You find the deals that, and if you do see something on that 8 or 10 cap, it's going to be on pro forma, which stands for future value, right? That's the hope, the speculation, what it could be worth one day.
Yeah. We're
buying, for clarity for everybody listening, we're buying on actual numbers. We're justifying the actual numbers, and we're buying. I just tied up a deal in Texas last week. My guy here in office, Matt Vincent, he's my acquisition team manager, and Matt located a property in Texas that was actually on market, and we were able to tie that property up, and it was like 9.8 cap.
Wow.
Yeah, it's a 50-unit big box.
Yeah.
Storage, and I'd say there's about 900,000 in the deal.
Okay. Wow, that's amazing. So that's amazing. So that's so they are out there, and you just need to find them. You give some pretty good criteria. But now let's say that you have someone that an investor, they want to buy this deal, they want to get involved. You had some pretty good ideas around like creative financing strategies for acquiring these properties. Can you talk a little bit about that?
Yeah. So part of what we do here in my firm is we identify property that has. Margaret, can you grab the charger for me so I can plug it over here? Part of what we do is we focus on properties and utilize certain strategies like seller financing is one. And people, they think they hear seller financing, they're like, why in the world would anybody ever seller finance me? Like, again, BS detector goes off. And, the fact of the matter is, Eric, is if you have a property that's sitting at low occupancy, it's not going to qualify for bank financing, number one, right? Yeah. And if it's sitting at low occupancy, a lot of people don't want to buy on performance and future value and pay for that potential. They want to buy on the as-is value, right? So there's 2 strikes against the seller right there. And then the third strike is the story, the reason on why they would ever sell. And we find when we hone in on back to the human element of business and the psychology of business, we understand that if we can ask the right questions and we can justify what their needs and desires are, we can also back it up with the current financial situation that we're up against right now, meaning interest rate.
Yeah.
And banks, I talk to lenders all the time. Last time I had a discussion with the lender, which was a couple of weeks ago, they said, Terry, we'll loan you money, but it's going to be at a high interest rate.
Yeah.
Because interest rates are up.
Yeah.
And they said, we're only loaning money to people who don't need it.
Yeah.
I said, what a concept.
Yeah.
Concept. Why is that though? Because they don't want to put their risk in play.
Yeah.
So what will these people do? these banks will have you show 2 years tax returns, 2 years bank statements. They want your firstborn, basically, meaning cross collateralization. They want to know all your other assets. They're going to look at your Schedule E on your tax return, and they're going to see everything else that you own. They want to make sure that your debt to income ratio is good. You don't have too much high credit usage. They want your personal guarantee. Everything that we do is on a non-recourse basis here in office. Every deal we do has no personal guarantee, so the credit never comes into play. We're never personally guaranteeing. We're never cross-collateralizing. Everything we do is entity structured. We use certain entities in certain states that allow for something called anonymity. So we remain anonymous on the entity, and everyone is in its own business in a box.
Yeah. Oh, that's great.
Yeah. So regardless of the property type, it's truly irrelevant. And we have deals that will move forward and wholesale the paper right away, or we will never even close it.
Yeah.
If we are going to close a deal, it has to meet about the 7-figure marker.
Okay.
Wholesale it, it's $100,000. If we're going to close it and go through the steps of contacting our business, entity, and develop that LLC and develop that relationship with a marketing and management company and do site visits and all that stuff, it's got to have $1 million in it, or we're just not interested.
Yeah, for sure. Yeah. And so normally for these deals, so about seller financing. So I just want to touch back on that, because the first building I bought had seller financing, bought that a long time ago. Yeah. And I had no money. So I was 18 years old. I had no money. So I got like a credit union to give me the first 80% in first lien position, and then the owner, the seller, basically financed the rest of that. So I had like no money down, and the thing was cash flowing even after that. And it was not the prettiest building, but it was cash flowing, and no money down. So they do exist. I mean, they do have seller financing, but you have to ask.
This deal behind me, this is 65 units. There's 16 fourplexes on 8.5 acres in Texas, and we did about a $500,000 reno on this multifamily.
Oh wow!
And I'll tell you, I mean, I got this thing for a 29-year seller finance note. That's why it made it on the wall. And some don't make it on the wall. So these ones over here didn't make it on the wall. But if the artwork makes it on the wall, then there's a story to be told. And this guy bought and sold notes. He was a broker / investor himself, acting as a investor in the transaction. Full disclosure on that. And the guy was cool, and he understood that he just was a really bad landlord, and he was slumming it. And these people that lived here, it was a poor quality of life because it was a C-class property that was run down. Yeah. So we went in there and we stabilized it at market occupancy, which was 95%. There was millions of dollars to be made on it. Where, this deal over here, here's my old CBS condenser radio. Yeah. This deal over here is in your neck of the woods. This is actually a deal that I purchased and owned for 9 months out in St. Augustine, Florida.
Okay.
And I got this one on a 7-year seller finance note. It was an assumable, transferable, non-recourse seller finance note. Wow. So when I created this non-recourse 7-year note, it was at
what was the loan to value on those notes?
There wasn't loan to value scenario because it was all seller finance. There was no bank involved.
Yeah.
And the value, we never disclose what our true values are. We do get sometimes appraisals. If we do, it'll be an MAI appraiser, which stands for Member Appraisal Institute. Yeah. But on most of these deals, Eric, we don't bother getting an actual appraiser because
because you know the value.
I have a finance background anyway. Yeah, we know the value.
But what I meant is that what was the percentage of the seller notes, like on the purchase price that you agreed to?
That purchase price was $480,000 was the purchase price, and we put down $100,000.
Okay.
And the property was sitting. Every property's got a story. That property was sitting at about 90% physical occupancy. Mm-hmm. But the manager was putting money in his pocket. Yeah. And it was trading at about 65% economic occupancy at the time of the purchase. Wow. So I bought that property for 480. 9 months later, I sold it for 900,000.
Yeah. Wow, that's very good. The other thing, and when people are saying, well, you can't find these seller financing deals, is because you're asking the wrong questions, and the discussion, if you keep the discussion around the price, that's all you're going to negotiate, is just going to be the price. There are other things you can talk about, is trying to understand why they're selling the property. Are they trying to, like the old man that who bought the apartment building, for example, he wanted out, and he wanted his money because he wanted all his money because he wanted to invest somewhere else, and he had another property in mind. But
Sure.
other people, other sellers, they're interested in, they like the cash flow that they were getting with the apartment buildings, but they didn't want to have all the headache and stuff like that. Well, what about if you lend me the money, you're going to get I'm going to double your cash flow that you were making, maybe, or whatever, and then I'm going to take this property off your hands. So how would you like that? Would you give a seller financing on something like that? And I think a lot of the sellers, they would potentially prefer that. They also afraid, some of them are also afraid of selling the property, because they don't want to pay capital gains. So there's a possibility of kind of like doing a DST or doing other kinds of techniques so that they don't pay capital gains, and that capital gain is spread over a longer period of time.
Yeah, we do all kinds of creative things here in office for those strategies as well, Eric. And obviously being in this business for 25 years, I've pretty much seen and done it all. And it's the way that you dress it up, on the negotiation, just to give some additional quality give back and content for your listeners. One of the ways that we get these sellers also to do the seller financing is we play on the greed aspect of it, and people like money.
Mm-hmm.
And we have to understand some things before we get into the deal. And we need to know 5 things before we want to know anything else, which obviously is what's the ask price, like what's the best offer they turn down, what's the as-is value, and we calculate that with that net operating income formula on the cap rate that I had mentioned, so we know what the true as is, remember the actual value, and then highest and best use on future value. Then the loan amount, number 4, which is really important to understand exactly where their payment is and when it balloons, because you have that intel before you can start negotiating anything. And then lastly is the repairs, because that does have a huge influence on your overall purchase price. Because if you're buying it for $1 million, let's just say, and it has $250,000 in repairs, you're not buying it for $1 million, you're buying it for 1.25. So that's just very simplistic way to give some quality give back to your listeners, just to let them know that not to do things prematurely, but just to be lucky. And I don't say that lightly. I mean, we're very lucky here, and to identify what luck is, people hear lucky, they think of like, Lucky Charms and rainbows and pots of gold. But when I'm saying luck is, I'm saying to be present, the knowledge, and then to take that relentlessness for success, continuous action. And that really is the secret sauce behind every business model, understanding the scope of work, the timeline, and the cost of doing business, and then understanding the knowledge base and understanding that exercise of repetition, because you can't sit around and wait for deals to fall out of the sky, because they never do.
Yeah, exactly.
So
you have to
for your listeners, Eric, I promised them the book, so I wanted to just write this down here so they know. All they have to do is send an email here. I'm huge on support. Support at, and then my name, which is Terry Hale. And if they need to get in touch with me for anything, they can email support@terryhale.com.
Excellent.
I'm an accessible person, and what my main focus is now, Eric, is to transition my business model. I have my folks here in office working with me that are in my boutique firm here in Malibu, but obviously I've branched outward, noting that I only have 24 hours in a day as one individual here in my boutique firm in Malibu. Obviously the training and the whole methodology behind that is to educate people and then partner with those people. And I've been doing that for the latter part of 25 years. And I put together 8 different curriculums of training and some wonderful ways to get people educated very quickly, and meet with them every week to nurture that relationship and to build that business in a box together. And then we share in the profits, which is great. So what I'm doing is duplicating myself with people that are coachable, trainable, and that have that, again, relentlessness for success.
Yeah, that's great. Well, thank you very much. Thank you for your time. So, so if people want to reach out to you, support@terryhale.com. So send him an email and make sure that you get that book. And full of information. And I'm sure in there if you have more questions about where to get the deal, you also mentioned about the commercial buyers club. Also, so any kind of information questions you might have, send that to support@terryhale.com, and they're going to be able to help you out. So Terry, thank you very much for joining me. Thank you for your knowledge and experience and sharing with us. Appreciate it.
Thank you, Eric.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.